Let's rewind to when the internet lost its mind over NFTs, non-fungible tokens. They were digital receipts on the blockchain, claiming you owned a unique digital thing: art, a video, a cartoon ape. Suddenly, every celebrity was an NFT expert. Athletes were dropping collections, and Twitter was full of pixelated profile pics. The hype was everywhere. This was the future of ownership, the democratization of art, a way for creators to finally get paid. Stories of people flipping digital rocks for millions made it feel like a gold rush. All you needed was some crypto and the guts to click buy. Social media became the new trading floor, and NFTs were your VIP ticket to the coolest club in the world. It felt like everyone inside was getting rich overnight. The message was clear: get in now or get left behind. This wasn't just investing, it was a cultural movement. The language was urgent. Floor prices are sweeping, diamond hands to the moon. This was faster, cooler, and full of cartoon animals. But when hype is the only thing holding up the price, what could possibly go wrong? As we'll see, things can go very, very wrong. The NFT craze was a perfect storm. New tech, celebrity endorsements, and the timeless dream of getting rich quick. But beneath the surface, it was all about hype. The question wasn't if the bubble would burst, but when. And when it did, the fallout was brutal. So, what made NFTs so different from traditional investing? Let's take a look at the old-school way of building wealth. Spoiler: it's a lot less exciting, but a lot more reliable. Before NFTs, people built wealth the boring way, the stock market. Buying stocks means owning a slice of a real company. Apple, for example, makes your phone and earns real money. The goal? Slow, steady growth over years, not overnight riches. You research, diversify, maybe buy an index fund, a smoothie of hundreds of stocks. The stock market has rules and oversight. The SEC keeps things, mostly, honest. You can see a company's profits, losses, and decades of data. It's a system based on information, not just vibes. In contrast, NFTs were the Wild West. No regulations, no safety net. NFT value depended on what the next person would pay, nothing more. That's called the greater fool theory. You profit only if someone else is willing to pay more for your hype. Stocks are about owning productive businesses. NFTs were about owning a piece of a moment. And moments end. Hype fades. The stock market is a marathon. NFTs were a sprint, often off a cliff. The difference? One builds wealth. The other just builds excitement. The NFT world was all about the rush, not the fundamentals. And when the rush ended, so did the money. So, what happens when a responsible investor gets swept up in the mania? Meet Mark. Meet Mark, a regular guy, graphic designer, 2 cats, mortgage, and for a decade, a model investor. He put part of every paycheck into index funds, building wealth brick by brick. His portfolio doubled over 10 years. Not flashy, but secure. Mark felt smart, responsible, and on track for retirement. Then, in late 2021, he discovered NFTs. It started with a tweet, then an article about a digital artist making millions. Mark joined Discords, got swept up in the energy, and saw people making in a day what he made in a year. Suddenly, his slow gains felt pathetic. He bought some Ethereum, navigated digital wallets, and bought his first NFT, a cartoon from a hyped project. The rush was instant. It felt like a lottery ticket you could brag about. Mark, the careful investor, was now Mark, the Web3 pioneer. That first taste of hype was all it took. He started spending more time in NFT communities, chasing the next big thing. The language was intoxicating. "Wegme, we're all gonna make it." Mark's disciplined habits began to slip. He told himself it was just a small experiment, but the line between investing and gambling blurred fast. The more he won, the more he risked. The more he lost, the more he chased. Mark's story was about to take a turn. The NFT world was designed to keep him hooked. FOMO, floor prices, and Twitter gurus were waiting. The slow grind was out. The hype train was full speed ahead. But the ride was about to get bumpy and expensive. Mark's small dip became a deep dive. NFT spaces thrive on FOMO, fear of missing out. His feeds filled with stories of people flipping $500 into $50,000. Every project was the next big thing. Mark spent hours on Discord and Twitter, learning the lingo and following anonymous gurus. He stopped his automatic investments, even sold some stocks to chase NFT wins. The wins felt genius, tripling his money in days. But he never cashed out, always rolling profits into the next hype. Each transaction was a gamble, not an investment. In the NFT echo chamber, everyone called it investing. But Mark was just chasing dopamine. The line between smart and reckless blurred. The stakes kept rising, and the risks were about to catch up. Mark soon hit the hidden costs of NFTs. First, gas fees, blockchain transaction costs that could be hundreds of dollars just to buy or sell. Then came rug pulls, anonymous teams hyped projects, sold out, then vanished with the money. Mark was left with worthless JPEGs and broken promises. But the biggest trap? Liquidity. Stocks can be sold in seconds. NFTs need a specific buyer at your price. When hype cooled, buyers vanished. Mark's wallet was full of NFTs he couldn't sell at any price. Stocks are backed by real businesses. NFTs were backed by belief, and belief evaporated. No dividends, no earnings, no safety net. When demand died, so did the market. Mark's assets became frozen, unsellable, and ultimately worthless. The NFT world's risks weren't just financial, they were psychological. The illusion of easy money was powerful, but reality hit hard. The party was ending, and Mark was about to pay the price. The NFT party didn't end overnight. It faded painfully. As the economy tightened, risky assets like NFTs were the first to go. Floor prices crashed. The community screamed, "Hold the line," but the rebound never came. Mark watched his net worth plummet, convinced the market would recover. But the drops got steeper. 10% became 90%. Projects worth millions became worthless. Celebrity promoters and Twitter gurus vanished. Discords turned into ghost towns. Mark was left with digital assets worth a fraction of what he paid. Gas fees to sell were higher than the offers he got. The dream was over. The hype had moved on. Mark faced the reality. He'd traded years of steady growth for a few months of mania, and lost. Let's do the math. Mark spent 10 years building a $150,000 portfolio through slow, steady investing. Then he pulled out over $100,000 to chase NFT riches. At the peak, his NFT wallet showed $300,000 on paper. But when the crash came, that value dropped by 95%. His collection, once worth a house, was now worth less than a used car. After the dust settled, Mark had less than $5,000 left from his $100,000+ investment. He lost more in 1 year of hype than he gained in a decade of discipline. The real loss wasn't just money, it was time. Retirement goals set back by years. Security gone, traded for digital images nobody wanted. The shortcut led straight off a cliff. The lesson? The slow path is the only path that lasts. Hype is fleeting, regret is real. Mark learned the hard way. So, what's the takeaway? It's not that new tech is bad, it's about knowing the difference between investing and speculating. Mark's stock strategy was investing, buying productive assets with real value. His NFT strategy was pure speculation, betting on hype, not fundamentals. The slow, boring path built wealth. The fast, exciting path destroyed it. This lesson matters, especially for women. We're often targeted with quick fixes, fad diets, miracle creams, and now get-rich-quick investments. The hype machine preys on feeling behind, promising shortcuts. But real financial power is built brick by brick. Education, discipline, and long-term focus. Boring is beautiful. Boring is stable. Boring is powerful. Compounding interest is the real magic, but it takes time. Don't let hype distract you from the proven path. Build your foundation on rock, not clouds. The slow way is the strong way, and that's how you win. So, how do you protect yourself? 3 rules. First, question the hype. If everyone says it's a sure thing, be skeptical. Hype creates FOMO, and FOMO leads to bad decisions. Second, protect your capital. Never risk money you can't afford to lose, especially on speculation. Don't dismantle your safety net for a lottery ticket. Keep core investments boring and reliable. Third, understand what you're buying. Don't just follow headlines or celebrities. With NFTs, you owned a digital receipt. Not the art, not the copyright. The hype cycle thrives on confusion. Mark's story isn't just about NFTs. It's about every get-rich-quick scheme. The names change, but the psychology is the same. Be patient, be skeptical, and build on solid ground. Don't let hype hijack your wallet.